In a period when all countries were drowning in debt, a young state managed to attract investment, strengthen its currency, and emerge from crises by growing. The rise of the American economy owes not only to its productive power but also to skillfully constructed financial maneuvers. Behind the visible growth, there were strategic money plays that most people did not notice. If you enjoy this kind of content that tells the behind-the-scenes stories of economic history, don't forget to subscribe to the channel, because here we talk not about the results, but the system. In the first years after the founding of the United States, there was no strong economy in place. The War of Independence had just ended, and the new state was facing a serious debt burden. The Continental Congress had printed money during the war, but this paper currency quickly lost value. A confidence problem had also begun to appear in the market. People were accepting government money at a discount, and some merchants were refusing it entirely. Without economic trust, collecting taxes was becoming increasingly difficult. This was the first major issue facing the new country: building trust. At this point, Alexander Hamilton stepped onto the stage. When he took office as Treasury Secretary, the most critical step he took was gathering the scattered state debts under a single federal structure. At first glance, this move was risky because it increased the central debt. But contrary to what many thought, Hamilton was thinking differently from everyone else. According to him, a large debt that is regularly paid is more valuable than small debts that are not paid. The federal government assumed the debts and clearly declared its commitment to repayment. This sent a strong message to investors. The new state would not deny its debt. It would manage it. Then the national bank model was established. This structure was designed not only to print money, but to regulate credit flow and provide a financial backbone to the state. The bank served as a bridge between the government and private capital. Thus, both the public and private sectors met within the same financial system. This design was quite innovative for its time. Another important step was taken in the tax architecture. Debt could not be managed without creating central revenue. For this reason, customs duties and consumption taxes were systematically put into effect. While revenue was obtained from foreign trade, domestic production was also protected. The young economy established revenue generation and debt payment, disciplined together from the very beginning. The foundation of American economic power was laid on this early financial order. One of the most critical applications of the financial architecture built by the young American state was turning debt from a burden into a tool. While many governments in Europe viewed debt as a shame that should be hidden, America recorded its debt transparently and transformed it into a tradable asset. Government bonds stopped being only a financing instrument and became documents that built trust. These bonds could be bought and sold, used as collateral, and priced within the market. In this way, public debt stopped being a static ledger entry and turned into a liquid financial product. This approach gave capital mobility. Investors saw that instead of locking their money away, they could lend to the government and convert it back into cash in the market. Liquidity increased trust, and trust created greater borrowing capacity. During the same period, the government deliberately encouraged the development of financial markets. Organized markets for securities trading began to emerge. Early stock exchange structures established in New York turned into centers where government papers and company shares changed hands. This provided an advantage not only to investors but also to the state, because price debt meant measurable risk. Measurable risk meant a broader investor base. The banking system also expanded during this process. State banks and private banks increased credit creation. Credit expansion accelerated trade and entrepreneurship. However, a delicate balance was established here. The money supply was not left completely uncontrolled. National bank and treasury policy provided a framework that monitored credit flow. In other words, while growth was encouraged, financial control was not abandoned. In addition, the government consciously used customs policies to protect industry and production. With high import taxes, room was created for domestic producers. This accelerated capital accumulation in the internal market. While external competition was limited, scale grew inside. As a result, an economy emerged whose financial markets developed while its production capacity increased. The difference of the American model becomes clearly visible here. Debt, banks, and markets were designed together as functioning parts of the same strategy. Another move that was highly important in the early rise of the American economy was that they kept the monetary system flexible and established, a system that could be guided. Instead of locking the money policy completely to gold or silver and chaining it to metals, the young state preferred a system that could expand and adapt when necessary. Officially, there was a metal-based currency system, but when it was desired to increase the money supply, the amount in circulation could be expanded through credit creation and banknotes. This gave the economy significant speed, especially during growth periods. Trade expansion meant monetary expansion as well. While many European economies slowed down due to money scarcity, America was able to move more agilely with credit-based expansion. Behind this approach was a simple but powerful idea. Stagnant money slows the economy. Circulating money grows the economy. Banks produced economic activity, not only equal to the gold in their vaults, but equal to the credit they issued. Of course, this model also carried risk, but the appetite for growth was placed ahead of the fear of risk. In the same years, land policy was also used like a financial instrument. The federal government opened vast Western lands directly to the market to encourage production and settlement. Land sales provided revenue to the state and accelerated population movement. Land was not only geography but collateral. Farmers and entrepreneurs were able to show their land in exchange for credit. Thus, property turned into fuel for the financial system. Unlike the large estates owned by aristocracy in Europe, land in America changed hands faster and joined economic activity more quickly. This increased capital circulation. Another strategic preference was a legal structure that rewarded entrepreneurs instead of punishing them. Those who went bankrupt were not completely pushed out of the system and were given a chance to try again. This culture encouraged risk-taking. More risk-taking produced more enterprise, and enterprise created more production and financial movement. The state did not enter every business directly, but it wrote the rules of the game in a way that supported growth. The monetary system, credit structure, and property order worked in direct alignment with each other. In this way, the economy not only grew, but accelerated significantly with this perspective. One of the key points that separated the American economic model from others was that it viewed crises not as events to be suppressed, but as opportunities for restructuring. From the early period onward, the country experienced financial panics. Banks failed, credit chains broke, and severe contractions occurred in the markets. However, after every collapse, the system was rebuilt in a more centralized, more rule-based, and larger-scale form. Each crisis added a new layer to the financial architecture. The bank panics and liquidity squeezes of the 19th century led money and credit control to shift from scattered structures to more coordinated ones. Eventually, the idea of central banking gained strength and the Federal Reserve System was born. This structure was designed not only as an institution responsible for issuing money, but also as a balance mechanism that could provide liquidity to the market during times of crisis. Thus, a lender of last resort was created so that credit would not completely freeze during panic periods. This changed the rules of the game in terms of financial stability. Another strategic step was the cooperation model established between the state and large capital. Railroads, heavy industry, and infrastructure projects grew with direct or indirect public support. The state provided incentives, land, and contracts. The private sector built, operated, and scaled them. This model both shared risk and accelerated growth. Large infrastructure meant large markets. Large markets meant large finance. During the same period, the role of the dollar was also deliberately strengthened. The widespread use of the national currency was encouraged. The federal payment system was expanded, and public transactions were tied to a single monetary standard. A common currency formed the foundation of a common market. Internal trade friction decreased. In addition, the legal system made contract security a priority. Contract enforcement, the most critical factor for investors, was strongly protected by the courts. This created an attractive environment for both foreign and domestic capital. Capital seeks safe harbors. America provided this security together with its legal infrastructure. Thus, a financial structure emerged that experienced crises but expanded its institutional capacity each time. One of the turning points that enabled the American economy to become the strongest economy on a global scale was that it did not think of the financial system only nationally, but designed it on an international scale. Especially after the first half of the 20th century, America moved into a rule-setting role in the global economy by combining its production power with its financial structure. After the First World War, while Europe was exhausted and in debt, America was in a creditor position. Capital flows changed direction. Gold and reserves began to move to the other side of the Atlantic. This was not only enrichment, but a shift of the financial center of gravity in the international economy. Banks, funds, and credit mechanisms increasingly began to operate on a dollar-centered basis. The real big leap came with the new monetary order, established after the Second World War. With the Bretton Woods system, the dollar settled into the position of global reserve currency. Many countries pegged their currencies to the dollar, and the dollar was tied to gold. This structure gave America a unique advantage: the privilege of standing at the center of global trade with its own currency. As countries accumulated dollars to hold reserves, America was able to borrow at lower cost. This was an invisible financial lever. In the same period, the architecture of international financial institutions was also built under American influence. Having a voice in global credit, development, and liquidity mechanisms created not only economic but geo-economic power. In addition, capital markets were deepened. The scale of stock and bond markets was expanded, and the diversity of financial instruments was increased. Risk was distributed and investment channels were multiplied. As investor options increased, the system attracted more money. External savings moved toward American assets. This meant cheaper financing inside the country. Another important preference was innovation financing. Risk capital was directed to new technologies and ventures. Financial bridges were built between universities, defense, and the private sector. Thus, finance funded not only current production, but also future production. The American model became clear here. Money did not only circulate, it was directed correctly. Finance did not remain only a supporter, but turned into a strategic instrument. The American economy becoming one of the strongest structures since its founding was not tied to a single miracle or a single resource. This strength was born from the combination of consciously designed financial rules, a flexible monetary structure, deep capital markets, and a trust-centered legal foundation. In the early period, turning debt into a tool, establishing a national banking backbone, using credit expansion as a growth engine, and transforming property into financial collateral were critical thresholds. Then, instead of ignoring crises, using them to update the system, establishing a central monetary authority, and adding a lender of last resort liquidity. mechanism to the market made the structure more resilient. On the international stage, placing the dollar at the center of trade, using the reserve currency advantage, and taking a decisive role in the architecture of global financial institutions, expanded the scale of the game. Thus, the American financial system turned into a center that financed not only the domestic economy but also the outside world. At the core of this model were three behaviors: producing trust, providing liquidity, and distributing risk. Trust was delivered through contracts and law. Liquidity was provided through market depth. Risk was spread through instrument diversity and scale. The striking point was this: the system was not perfect, but it was adaptable. After every major shock, the rules were updated, the tools were expanded, and balance mechanisms were added. This flexibility defeated rigidity. The things called financial tricks were often not hidden moves, but structural design choices: marketizing debt, being able to expand money, turning assets into collateral, converting crisis into opportunity, and growing the currency through network effect. For this reason, strength came not only from production, but from financial architecture. If you have watched this far, thank you sincerely. This story explains not only America, but how money produces power. In your opinion, what truly makes an economy strong? Natural resources, production, or financial design? Write your view in the comments. Different perspectives deepen the subject. If you found the video useful, I suggest you like it and subscribe for similar economic stories. See you in the next video.